Source documents and subsidiary journals are very important in any business. So if we look at the source documents, every time when a client comes into the business and they buy something, you have to issue them with an invoice. If they come in and they pay, you have to give them a receipt as proof that they paid their account. So it means for every transaction in a business, you will use a source document, because this source document is used by the bookkeeper to record all the entries of the business in the subsidiary journals. The original copy will be given to the client, so he will get the top copy, and the duplicate that's inside the book that doesn't get torn out or on the computer will be kept to record the transactions in the journals. So remember, if we receive any money, we record it in the cash receipts journal. If we pay out any money, we record it in the cash payments journal. So any money coming into your bank account or out of your bank account, you must decide, must it be receipts or must it be the cash payments? Now, if I look at the word cash receipts, it tells me it's when I receive cash, and that's why I put it into the cash receipts journal. When services are rendered for cash, then you can give them a cash invoice. So some businesses don't have the necessary equipment to do it electronically, so they will just write out a cash invoice. Or if you go in a normal shop like Checkers, you will get a cash register slip. So it means the money that you receive because services was rendered to your clients or because you sold goods to your clients will be a cash invoice if you don't have the necessary equipment, or it will be a cash register slip. So if you go into Checkers, you know when you go out and you pay, you receive a cash register slip every time. When money is received, for any reason why they bring the money in cash to you, so they want a receipt as proof that they paid this transaction. So that nobody's going to just give you money and you don't give them proof that they paid the money. So that will then be a receipt. When money is received, the duplicate is used to record the transactions in the cash receipts journal. And at the end of the day, the money will be deposited into the bank with a bank deposit slip. So you don't go to the bank every time when you receive money. You go once a day. So some businesses go early in the morning and some businesses go late in the afternoon, so that they don't have all that money in the business and they rather take it to the bank before they close. So in the school, we accept that we always deposit the money at the end of the day. So all the money that you receive during the day, whether it is for a debtor that came and paid his account, money that we receive for cash sales or services rendered, so any money that we receive, we will issue a receipt if it's not sales or services rendered, because then we give them an invoice or a cash register slip. Okay, then money is paid directly with an EFT. It means that the people don't come to the business, they sit at home or in their business and they transfer money electronically to my business. So the money will be recorded in the cash receipts journal because we receive the money the day when the person pays over the money to our bank account. Services rendered with a debit card. Now, it's very important that you must understand the difference between a debit card and a credit card. A debit card is connected to your bank account. So it's linked to your bank account if you swipe it at any business where you buy goods, the bank will automatically transfer the money from the account of the client in the bank to the bank account of the business. So it means if the business sells goods and people pay with a debit card, the money is transferred immediately and it is treated as cash sales. A credit card is the customers have a credit card and they owe money to the bank. So if they buy anything with their credit card, they will have to pay this money to the bank at the end of the month, or sometimes they get 3 or 6 months to pay it. But the business, if we have a business and we sell goods or we render services and somebody pays with a credit card, we treat it as a cash transaction because the bank will pay the money the same day into the account of our business. This client who pays with a credit card doesn't owe us money. He owes the money to the bank. We get the money immediately. So the difference between these two is the debit card is linked to your normal bank account and the bank will transfer it automatically from your bank account to the bank account of our business. If a client pays with a credit card, we also receive the money the same day, but the client owes the money to the bank. So from the client's point of view, it is a credit transaction. From our point of view, it's a cash transaction. Okay, if we pay out money, when an EFT is used to pay for purchases or services or creditors or whatever, it means that money is transferred from our bank account to the account of the supplier. And if we take money out of the bank, whether it's with the EFT or we withdraw money, it is recorded in the cash payments journal. Sometimes the business needs cash so that they can pay small amounts and they withdraw money at the bank or at the ATM. That means money goes out of the bank account and we will record it in the cash payments journal. When we, the business, use a debit card for payments, then it means the bank will take the money directly out of our bank account and put it into the bank account of the supplier. So from our point of view, it's a cash transaction. So when we pay with a debit card, it means that you will still record it in your cash payments journal because it is a cash transaction. If we pay with a credit card, you can't show it in your bank or in your cash payments journal because we get a credit card from the bank and they allow us to have a certain amount of credit. So if we buy anything or we pay something with a credit card, we pay the supplier. They satisfy because they get their money immediately. From our point of view, we increase the money that we owe to the bank, so it's not a cash transaction. You will record this as on a credit card account and show that you owe money to the bank, and then when you pay the bank at the end of the month, you will show that money goes out of your bank. So if you pay with a credit card, it cannot be recorded in your cash payments journal.